In this video, we'll be diving into seeing how you can rent your current home and then buy the next. This is going to be another fantastic tool for you, and understanding the pros and cons of this, along with other factors to consider when potentially using this option. Now, before we get too far into this, I do want to define what this strategy is. And it is when you rent out your current home, and then from there, you would then buy the next home using either the equity in your current home, or if you have enough cash reserves, then using those cash reserves to then buy the next home. This will then allow you to have some rental income, which is always beneficial. Now, the benefits of this is going to be the fact of having rental income. This is going to be helpful in offsetting your debt to income ratio when you are buying the next home, and especially if it is financed. And on top of that, you will potentially have some additional income that would go towards the monthly payment for your new home. And when we're looking at the other advantage of this is going to be the potential tax advantages. There's usually going to be a certain degree of tax advantages when it comes to owning a rental property and being able to write off potentially more, and especially when it comes to depreciation. Another advantage to this is that you're building your real estate portfolio. One of the things that you will want to do later on or now is going to be building up your assets. Assets are going to be very helpful for you later down the line, and especially with the compound potential of homes. You could hold on to that rental property for a longer period of time and then sell it off at a more opportune time when you maybe need a little bit more cash or need later down the line. Now, with the benefits of this technique, there definitely comes some cons. And number one is most likely going to be the fact that you are going to be a landlord. Typically, this is not the most fun thing to do, and you are running a business in sorts. You will be helping out with in terms of getting new tenants, making sure that maintenance requests are done, and you have enough in reserve to deal with any large issues or vacancies that do pop up. This is like running a business, which is maybe not the best thing for everyone, but is something to consider when you are looking at using this strategy. For some, this might actually be very beneficial, or it may already be in their wheelhouse, so it may not be as big of a deal, especially if you get tenants that will stay there for 5 to 10 years. You don't have a lot of turnover and they're fantastic tenants, but there's also horror stories that go along with that as well. Going into the second con is keeping up with the current landlord-tenant laws. These are laws that are between the landlord and tenant and what they can and cannot do. In Oregon, it is a lot more of an evolving situation where we do have bills out every year or so that change the landlord-tenant laws, and it's always going to be something that you will need to make sure that you're up to date on, to make sure that your property management is doing it properly along with yourself. Now, there are definite exceptions with this, is usually when you have 4 or less units, there are a little bit more flexibility with those rules, and it's always a good idea to talk to a lawyer or talk to a property manager about what those exceptions might be for you. Third con to note is that there's going to be some degree of market volatility. So with this, there is going to be times when it may be a little bit harder to rent, or you're going to have to deal with other factors that kind of pop into this as well, especially if you are looking to sell. And something to keep in mind that you're wanting to make sure that this is going to be a net positive for you moving forward in the future. Now, when you are looking at this strategy, it is important to run the numbers and see whether or not it's going to be effective for you at all. Because obviously you do not want to be having a rental that is losing a ton of money each month. And when it comes to seeing whether or not it would be a good idea for you in the first place, number one is you're going to go to rentometer.com. In this, you'll be adding the address, the number of bedrooms, and number of bathrooms to see how much rent you can actually get for your place. Note that there is an option to choose between apartments and then also single-family homes / duplexes as well, and that does make a huge difference when it comes to rent, usually anywhere between 10 to 15% depending on the area. Now, with that, if you put in all that information and then the rent meter projects out an average rent that is far below what your monthly mortgage payment is, it's probably going to be something where you will not be able to make the rental option makes sense for you financially speaking. Now, if it does make sense or it is above it, some things to keep in mind is that you're wanting to account for other expenditures. Some of the major ones you're going to want to be accounting for is one, property management, which is going to be anywhere between 8 to 10% of the gross rent or whatever the rent meter gave you. So keeping that in mind, take off that percentage. If you are self-managing, it is something to keep in mind that maybe later down the line, you could then have a property manager deal with it. If that's not the case for right now, you can just ignore that. And then the second thing is going to be vacancy. If you're looking at vacancy rates around 5%, so that way each month, part of that income would then go towards a emergency fund. And then depending on the house and how updated it is, you're going to be wanting to account for maintenance and capital expenditures. Capital expenditures being the roof or HVAC system, to make sure that you have the opportunity to account for that, especially when they do go out, because they will eventually go out, or either having a home warranty added on to that as well to make sure that you can have things serviced. So once you've gone through those calculations and seen whether or not it still makes sense, you're then going to see whether or not you want to move forward. And with this, I do have a calculator for clients that are wanting to have a little bit more in-depth, and this usually projects out 20, 30 years. So if you're ever curious about that, you're wanting to move forward on that, feel free to contact me down below as well, and we will dive into that a little bit further. If you have ever done this strategy, I would love to hear your thoughts and what you liked about it, maybe what you don't like about it, and feel free to comment down below. Now, looking at the other side of this equation, when you are buying, we are going to look at the financing options you have. And one of those options is just using the cash you have aside for the next down payment. You can still buy that next home and at about 5% for a conventional loan as well. And again, making sure that whether or not that DTI will work for you or the debt to income ratio is always a good conversation to be having with the lender as well. If you need any recommendations, feel free to reach out and I'd be more than happy to connect you with a local lender. And I also have lenders that work all over the states. So with that, once you are looking at that option, if that does not work, you maybe need a little bit more cash, then you can start using the equity in your home. There's a couple options you can use for this. One is going to be the HELOC or home equity line of credit. This is a revolving line of credit that may or may not have a adjustable rate or rate that adjusts. So keep that in mind when you are talking to a lender and see what the potential options are for you. There are a bunch of different programs from different lenders and different banks. Typically, when you go to a bank that is a credit union or a local credit union, they typically will have better rates for you. So it's a good idea to go around and shop around. Another financial option is using a home equity loan. And this is going to be a little bit more of a stable interest rate. And you basically are loaning against the equity you have in the home. Now, this really only works if you have a lot of equity in your home, anywhere between 10 to 20% of equity in your home to then leverage against, depending on the bank's standards. So with all this in mind, make sure to talk to your real estate agent to see whether or not this is a good option for you. And if you need any recommendations for that, feel free to let me know. I do have contacts all over the states. So moving forward, if you found any of this content helpful, it would be wonderful if you could tap that like and subscribe button. And thank you so much for watching.